Welcome to This Week in Impact, where ImpactAlpha editor David Bank and I break down some of the most interesting impact investing stories of the week. I'm Brian Walsh. It's Thursday, May 23rd. Today we'll discuss impact investing in asset classes beyond venture capital and private equity, how billions of low and middle income consumers represent trillions in investment opportunity, and how raising pay for retail employees can strengthen the global economy and portfolio performance. That's all coming up on This Week in Impact. Hi, David. Happy Thursday. Any big plans for the Memorial Day weekend?
Well, it's California, and it's the weather is great, and I hope to get some biking in and some hiking in and some good time with family and friends. How about you, Brian?
Well, it's beautiful here in Cape Cod, where I am right now. Excited to be here for the Memorial Day weekend. I'll be doing some biking, some hiking, and maybe some meatless barbecuing as well.
That's beyond impossible, I think, Brian.
Actually, I don't have a really strong opinion. I like them both, and I can't tell them apart. But they're both good, both beyond and impossible. The duopoly of the plant-based beef out there. All right, well, let's dig right into our first topic. Now, David, impact investing has gone far afield from just your traditional venture capital and private equity, and you've been taking a look at some of the innovations in new financial service products in the space. What does this mean, this productization of impact, and what are you seeing?
I think that's a good word, productization, Brian, because a few years ago, that was all the cry was we needed sort of standard issue people who would talk about plain vanilla products that could substitute easily into investors' portfolios that looked like the thing they were replacing. So now we've got a kind of wave. I don't know whether it's a tsunami yet, but we've got a very steady stream. We've just noticed it in the newsfeed of ImpactAlpha of new products, taking the tools of finance and turning, bonds, short duration bonds, high yield credit, project finance into impact products.
And what are some of these concrete examples?
Well, we had one this week. There's a short duration green bond ETF trading on the NASDAQ. And it takes, as I said, green bonds. They're sort of a known quantity now after many years being hammered out. Corporations raise money on the bond market to do very specific green projects. So the nice thing about them is, at least when they're done right, you can track the projects that are being funded by the bond. The problem has been that they've been a longer duration, even 3 to 5 years, when there's volatile interest rates and that sort of thing, had hit that market hard. So people thought there should be short duration, so you can buy the bonds when they've only got a year or two left. You have less exposure to that kind of thing. And now that's all wrapped up into an ETF that trades, and gives you daily liquidity. So it's, again, tries to take away the obstacles people might have had to investing in green bonds. CCSB is the ticker symbol, just for the plug there for our friends at Carbon Collective, which put this all together.
And now, importantly, this being an ETF that's publicly listed means that individual investors, retail investors, can invest in these. These aren't just tools for high net worth investors or accredited investors, and not just tools for institutional investors, but it's for the everyday investor who wants to have an impact with their investments, whether it's through their own brokerage account or through their 401k.
Exactly, Brian. In the case of the ETF, it's exactly that. It's liquid and it's on the stock market, and folks can have more access to it. And also, there are new products being brought out for institutional investors, for high net worth accredited investors as well. And it's all of a type, which is bring products in every category, both across income levels or asset size, as you mentioned, and also across asset classes. So, there people will have bond portfolios and stock portfolios, but they'll also might have cash management. For example, there's a note that you can get now called a climate cash product from C-Note that lets you just put you've got to put your cash somewhere for short-term holdings and that sort of thing. And so why not put it into a basket of community development financial institutions that are gearing up to do lending, as we've talked a lot about on this podcast, under the Inflation Reduction Act and the Greenhouse Gas Reduction Fund for neighborhood and residential projects, heat pumps and solar panels and EV chargers and that sort of thing. And so in every category, again, as I say, you can find something that fits your impact objectives. And if it meets the other objectives, why not?
Right. So this is where supply and demand meet, right? So we have the demand from consumers, from asset holders, asset owners who want to have impact in their range of financial engagements. And then you have then these financial services organizations that are bringing out these investment, if you will, the supply of investment products that are meeting that demand for impact products.
I'm so glad you said that, Brian, because you and I have always agreed on this, but we're a lonely crew that understands that in the financial markets, the demand comes from the asset holders and owners who need to put their capital to work, and that the supply is actually at the impact and entrepreneur, founder, and practitioner level who are delivering that impact. So thank you for putting supply and demand in the correct perspective. Sometimes folks think it's always the folks who want the money that are doing the demanding, and I think it's really the other way.
I will die on this hill with you, David. All right. Well, let's take a quick break there. When we come back, how billions of low and middle income consumers represent trillions in impact investment opportunities.
I'm Eric Carmen Gonzalez, ImpactAlpha's Director of Subscription Growth. Ever feel like there's so much happening it's hard to keep up? We hear you. That's why we created ImpactAlpha Latin America, a monthly newsletter for impact investors who want to keep their eye on trends and investments happening in Latin America and the Caribbean. Follow the money and connect with agents of impact powering Latin America's impact economy. Visit our Instagram page @ImpactAlpha and click on the link in our bio to sign up.
More than half the global population lives on less than $7 a day. Now, these trillions of dollars in spending each year favors companies who design and deliver services that improve their lives and livelihoods and support their families' economic resilience and futures. As Jessica Pothering reported for us this week, turns out there's a massive opportunity to invest in the global mass market, whether it's through energy services, financial services, education, healthcare, housing, agricultural, logistics, or other sectors. David, this was also the topic of our Agents of Impact call this week. And 20 years or so after CK Pralahad coined the term the fortune at the base of the pyramid, what's different about these approaches now?
Well, one thing that's different, Brian, is just the language. I think base of the pyramid is falling out of favor. It kind of reflects an old school of development finance, and really things are moving forward quite quickly, taking advantage of trends that have kind of been building for 10 or 20 years. Maybe people kind of lost faith in this notion that there was sort of, cheaper, better, faster solutions that would leapfrog existing technologies, particularly in the developing world. And in fact, that has happened now. So a lot of things, are just plain cheaper. Solar panels, connectivity, cell phone, and all that. And so we now have a whole new opportunity set, and we also have a whole new consumer set, and that's what people are getting to with the new framing. I think what we were arrived at on the call, a hat tip to Ami Patel at Elevar, was entrepreneurial households in industrious communities. Let's let her explain.
Take the similar analogy of BRICS, which was to prove to the capital markets that there's an opportunity within Brazil, Russia, India, China, and think of EPIC, which is the economic power of industrious communities. And industrious communities are comprised of entrepreneurial households that have tenacity, resilience, aspiration, ambition. And they are the largest segment across the globe. And we're using India as a test case and a proof case to showcase what that is. It's not poor people. It's not low income. Yes, they may be lower on the economic stratum, but we all have biases when we hear these words. Let's reframe this with positive, more opportunistic, long-term thinking and see this segment of the market as the future. And I think that if we can all start to believe and understand what EPIC is, huge opportunity set, that's when I think we can start getting some of the paradigms to shift in a different way.
And so I think the takeaway of the week of coverage and the call, as you mentioned, is that there's a rising consumer class and customer class that wants better products at cheaper prices in ways that make sense in the places they're at, be that urban, rural, et cetera. And that's a huge opportunity. It's, as you said, billions of customers. They have spending power. They're very sophisticated. They're all on mobile phones. They all know how to do fintech, financing and payments. It's a whole different world.
Yeah, and from the piece there, one fact that stood out to me about these entrepreneurial households is that this customer segment represents $8.8 trillion in annual spending in India alone. That's quite a lot of money.
Absolutely. And Elevar is a good example. They've got what I think they call the twin flywheel, and it just makes a ton of sense, which is that if your product or service is making money essentially, or saving money for your end customers such that they get a tangible financial benefit out of it, their livelihood is improved, they will pay you, less than that, a small fraction of that for that product and service. And so their financial success is your financial success as a company. And those are the kind of companies they'd like to back. The other part of the call was interesting too. The development finance institutions that put out this guide. So they're trying to lean into some leadership on this new way of thinking about things.
And what is that guide? Who is that guide for?
The guide is for other investors. So the DFI, so-called, the Development Financial Institutions. So one was British International Investments, obviously the UK one, and then FMO, which is the Dutch DFI, and then the International Finance Corp. And these folks operate in a kind of quasi-governmental role, but they function a lot as private investors, and they've been under a lot of pressure to be more catalytic, as we like to say at ImpactAlpha, and take more risks and go deeper, and also to catalyze private capital, crowd in private capital into these opportunities. And so this guide that they released this week through ImpactAlpha was an attempt to help other investors understand just what you were talking about, the huge opportunities among these entrepreneurial households for goods and services, and so get more private capital thinking that way of the sort of bottom-up opportunities, mass market opportunities. The pressures in investing, generally speaking, in those markets have been to push companies and founders up market to more affluent consumers, even in low-income countries. So you can invest in a low-income country, but only investing in their high-income population. So this is a way to get into not only low-income countries, but low-income populations.
All right. Well, it sounds like there's a lot of exciting opportunities in the space. We'll continue to keep an eye on it because these entrepreneurial households are not going anywhere. In fact, they are growing, if anything. But with that, let's take a quick break. When we come back, how raising pay for retail employees can strengthen the global economy and portfolio performance.
Every day, ImpactAlpha uncovers stories that make a difference to impact investors. I am Zalaima Bibo, Chief Operating Officer at ImpactAlpha, here with a special reminder. Subscribers get the award-winning brief 5 days a week and so much more. Unlock exclusive coverage, get access to subscriber-only calls and Slack channels, plus search hundreds of jobs and internships at the ImpactAlpha Career Hub. What are you waiting for? Subscribe today. Learn more at impactalpha.com/subscribe.
Shareholder advocates have long argued that in the long term, low wages cost companies more in lost productivity, high turnover, and low morale than they generate in short-term profits. David, can you walk us through why that's the case?
Well, so this is coming up now in proxy season as we're in. So the companies like Walmart, Target, and Kroger have their annual general meetings next month, and there are proposals in front of them to raise their wages to so-called living wages, and the details are different in each case. But it's a recognition, a long-standing fight that the minimum wage is way outdated, and most retailers are paying above the minimum wage. But just to actually raise it to what they call a living wage, which is something more like $25 an hour, as opposed to the $7.25 that the federal minimum wage. So that's been a longstanding fight, and you can make the argument that companies and Walmart and others have attested to this, that better pay and better treated workers provide a better customer experience, stay around longer, and that it's actually worth the extra pay and the extra expense to have to treat your workers like an asset, as we like to say. So that would be a whole different thing. You want to optimize the value of your workers by making them the best and most motivated and most productive and best customer-facing workers you could possibly have. That's the sort of high road, to retail, and some folks have taken it.
Now, it goes beyond just the performance of the individual companies. And as Sarah Murphy of the Shareholder Comments wrote in a guest post on Impact Alpha, that this proxy season, as you noted, shareholders are making the broader case that these below living wages also hurt investors' overall portfolios because it perpetuates inequality and depresses the economy. So why is that the case? Why do low wages actually not just harm the individual performance of the companies, but have that broader systemic impact?
Well, that's actually what's interesting, Brian, about this season is that this sort of systemic investing, as people like to call it, is sort of coming into its own, and people are starting to understand what it means. And Shareholder Commons has been at the forefront of that. And the point is that your portfolio, you're in a 401k, but certainly you're a major institutional investor. You own, the whole economy. People talk about universal owners. Your well-being is much more tied up in, where the S&P 500, even more broadly than that, is going than in that particular stock that you're voting your shareholder proxy on that day. So therefore, you're interested in the whole economy lifting up, and you could make the point that workers with more disposable income are buying more goods and services in communities, and that's raising the general prosperity of the whole neighborhood and the whole community, and that's a social good that we should all be in favor of, even if it might cost Walmart, Kroger, or Target a little bit more per hour. And as that realization and that calculation comes into play, then you might have like sort of more systemic pressure, as it were, for companies all to level up and say, look, this is a social good and also a business good for all of us to start paying more to our frontline and retail workers.
All right, well, it's interesting because there's a related development that we saw this week with Blackstone's embrace of employee ownership. And what kind of shift does this signal for private equity?
Yeah, there you go. Because it's kind of the same calculation in a different domain, which is that empowered workers that have a stake in the future of the company might stick around longer, and be more productive. And in a labor economy, where workers are scarce in many fields, that becomes a true business value. So Blackstone, one of the big private equity companies, has adopted a broad-based employee ownership strategy for the companies that it buys out with its private equity firm. And, private equity in general, and including Blackstone, has not had a great public reputation for job creation, more often, job layoffs and other predations as people think about, private equity. But now there's a shift. KKR was at the forefront of this and implemented it first in their manufacturing buyouts and then more broadly. Others have embraced it. There's an outfit called Ownership Works, a nonprofit that has collected up pledges and intentions and playbooks, as it were, for private equity firms to go in this direction. And now Blackstone is a sort of a major domino to fall in the private equity world as employee ownership becomes a kind of mainstream private equity play in the playbook.
All right. So from public equity with shareholder engagement during this proxy season to leadership in private equity, we're seeing a big shift from multiple sectors about kind of putting a focus on workers and worker ownership.
Yeah, there does seem to be a new a narrative emerging that there is a kind of shared prosperity to be had, and that this bigger pie, can ameliorate all sorts of divisions. I don't want to put too positive a spin on it or be too Pollyannish about it. I know there's a lot of power struggle involved in all of it, but I do think that it's dawning on folks that there's a better way forward, and some folks are trying to seize it.
All right, so not just slicing up the pie, but trying to create a bigger pie for everybody.
It's always been the way.
All right, that's going to do it for this episode. Thanks so much for listening to This Week in Impact. David, what's the best way for people to contact us with feedback?
I think you know the answer by now, Brian, and maybe our listeners do too, but we'd love to hear from them at podcast@impactalpha.com.
Great. Now, if you liked what you heard, please subscribe to this podcast wherever you listen and share it with a friend or colleague. And if you want to help us out, be sure to rate us and give us a review on Apple Podcasts. It really helps other people find the show. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. For more exclusive stories about the world of impact investing and sustainable finance, join other agents of impact by subscribing to Impact Alpha. Just go to impactalpha.com/subscribe for full access. Thanks to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, and we'll see you next week for more Impact.